Hello, everyone. Welcome back to another installment of our Lunch and Learn webinar series. I'm your host, Mayur Thaker. I'm the Senior Relationship Manager here at Zacks. And today we're going to be talking about GARP, growth at a reasonable price. And, we have, a lot of clients, that use the Zacks advisor tools as well as the Zacks research system, institutional level product in executing a GARP strategy. And I've listened to a lot of various approaches to GARP, and my goal here is to present a framework for understanding and walking through the long-standing timeless principles of value investing applied to growth companies. And really, I think this goes to show that just speaking about it logically, or just in common sense, everybody wants to be a growth manager, right? Even if you're a value manager, you want to make sure that the companies that you buy are growing rather than contracting, right? So everyone wants to buy companies that are in favor rather than falling out of favor, unless if you're a special situations investor and you buy companies in bankruptcy or other, really crazy scenarios. In general, we all those of us that are buy and hold long-term investors, we all want companies that are generally expected to grow over time. So we're talking about growth, but then we're also talking about valuation. And so everybody's a value investor as well, because no one wants to pay more than what a company is worth, right? So everyone is a growth investor, everyone is a value investor. So having these distinctions sometimes I think is misleading, but let's talk about that. So let's talk about a few of the ideas behind what we can think of when it comes to growth at a reasonable price. And just for a little bit of housekeeping, just wanted to put this disclosure up here just before we get started there. And here is a general framework. So what are we looking for? There's 5 broad points that I always like to look for when picking companies, especially companies that are within this model of GARP, right, growth at a reasonable price, which is where I think the vast majority of investment managers are. Even if you're a value investor, you still want companies that are generally growing rather than contracting. So what are we looking for? EPS growth, right? That's the first and foremost, most important thing. We want companies that are growing the bottom line, but also we want companies that are growing the bottom line with attractive returns on invested capital. And this is this is an aspect that I think is less discussed or less focused on. And I think that's where a lot of managers, fall into trouble because they're looking for high growth companies, but then they may or may not be high ROIC companies. And if you're a long-term investor, ROIC is generally speaking the rate of return that you will earn on your investment, assuming that you pay a fair price. And we'll get into that a little bit more. Also, what you want to know is there a large total addressable market, right? Because companies that have posted strong earnings growth in the past may or may not continue that into the future, because what if it's a completely soaked up industry? What if they have absorbed the most, the majority of the market share and can't really grow beyond that, right? We always have this risk of broken growth, right? Companies that have grown very rapidly in the past, over the past 3 to 5 years, but then suddenly slowed down. And that is because of a variety of factors. That could be competition, that could be an inferior product. It could also be because they've just achieved, market saturation. Gilead is a primary example of that. Gilead grew rapidly in the first part of this decade, in the 2010s decade, and then suddenly they became, a very stagnant sideways growth company. Still a cash cow, but the growth really tapered. Why? Because the hepatitis, C market was basically dominated by them. And then after that, there wasn't a whole lot of other opportunities to grow. So they ate into that total addressable market very quickly. and then they didn't have anything to replace that once that market saturation occurred. So we want a large total addressable market. We want a moat, right? We want companies that have a significant advantage, and there are various types of moats that we can think of. One type of a moat is a functional moat, meaning they simply have a superior product functionally. Another type of moat could be that they have network effects. We can think of, for example, Facebook. They have significant network effects, right? They don't necessarily have a functional moat, meaning, Google, for example, tried to replicate Facebook. They launched Google Plus. Google is no stranger to software development, right? They can easily produce a social media platform that, can do everything that Facebook does. But Google Plus was a big flop. Why? Because Facebook already had network effects. Once you get a certain threshold, that those network effects continue to build and build, and it creates this internal, positive feedback loop that makes the system better and better. And it makes it harder and harder for new entrants to actually enter that market and compete for that, especially if it's just a Me Too product, right? So Facebook has that network effect moat. There's also other moats in the form of brand loyalty, right? Brands are very, very powerful. We can think of all of the iconic brands out there, especially in consumer staples or consumer discretionary. Brands are exceptionally powerful. Warren Buffett, has talked about that, all throughout his career, and he has proven that, brand loyalty is very, very tough to overcome, and that is a form of a moat as well. So we want one of these moats to exist in the companies that we buy, right? And then lastly, as investors, we want a fair valuation. So the first 4 points are helping you identify great companies, right? And then the last point helps us as investors to make sure that this is actually a good investment, right? Because you could have a great business, but then, you could overpay for that and therefore have very lackluster returns. Warren Buffett in his annual letters has talked about this, very, very openly, which is, when, Berkshire Hathaway bought Precision Castparts, for example. Precision Castparts, checked off, each of these first 4 points. They had strong earnings growth. They had strong ROIC. They had a very large total addressable market. They had a moat. But, Warren Buffett did not, and it ultimately admitted that he did not pay a fair price for it. And therefore, Berkshire shareholders really suffered, because of that. And he learned his lesson from that, and he spoke about that very openly. So fair valuation is a key point that we have to talk about. So we can use the tools of ZRS and as well as advisor tools to help us find companies that have these characteristics. So let's talk about that. So there's 6 companies I'm just going to mention. We're only going to talk about 3 of them just out of interest of time. But I just wanted to throw up 6 companies here that you can think of that I believe have, checked off each and every one of those 5 points that we just saw in the previous slide. There's Teradyne, there's Etsy, CBRE, Ubiquity, Alibaba, and Pool Corp. These are just 6 examples. There's many more. But I think these 6 companies exemplify each of the 5 characteristics that we really like to look for. So let's talk about the first one, Teradyne. So what does Teradyne do? I think the first thing that we want to understand is, what does the company do? And once you understand what the company does, we can help identify, what their moat is, right? Because before even looking at anything like earnings growth or anything like that, we just want to know what the company does, and that will help us find out and understand if there is a sustainable moat or not in that. So Teradyne, what do? They are a producer and manufacturer and designer of automatic test systems for semiconductors. They also do test systems for memory storage, as well as test systems for aerospace instrumentation. So what does that mean? In these respective industries, the semiconductor manufacturers, memory storage manufacturers, and aerospace and defense, manufacturers, they all need performance benchmarking. And we can actually understand a little bit more about this from our Zacks Equity Research Report. I actually pulled this, these bullet point data, these bullet points directly from the Zacks Equity Research Report, which is a phenomenal resource just to get up to speed on companies. If you're not familiar with what they do, I always tell clients page 2 of that report is excellent as a resource to just quickly understand what companies do. So, just as a background, companies that produce, semiconductors such as Intel, um, as well as memory storage companies like Western Digital, Seagate, and aerospace and defense companies, they all need equipment that allows them to do performance benchmarking, right? Because once they produce these chips, they need to test to make sure that these chips are performing, up to their standards. And Teradyne is a company that specializes in this very, very niche industry. So this is a form of a moat that you can automatically kind of pick up. This is something that they do, that they specialize in, that very few, if anyone else can do. And they have significant experience and significant market share within that, right? So what they also do is industrial automation equipment. So if we've seen videos of high tech, next generation, for example, auto manufacturing, more and more auto manufacturing is being automated, right, with robotic arms, as well as robots that carry things from one place to another within massive warehouses and massive factories. Teradyne actually builds, manufactures, designs, as well as produces the software that is necessary for running those robots. So Teradyne is a market leader in robotics as well. So what's the TAM, right? What is the total addressable market? There's increasing need for semiconductors globally. There's increasing need of robotics. There's increasing, adoption of AI and machine learning. And there is the massive 5G rollout, right? As companies roll out 5G, they constantly need anything that is run on semiconductors, on memory storage, on any of these types of chips. They all need performance benchmarking. And Teradyne is the market leader with know-how, with the most R&D, with the most experience in producing those machines that does that performance benchmarking. So we can actually just check out their their website. I just have that pulled up here, and you can just quickly see exactly what they do just from their website. And here's one example of their of the type of test machinery that they produce. Super sophisticated, very high-end equipment, very specialized equipment, and this is something that nobody else really can do at that level in terms of their volume and their accuracy and their cost, really. So Teradyne is a market leader in what they do, something that very few companies can do, and something that all of the semiconductor manufacturers have decided that this is something that we would rather just have Teradyne do rather than for us to do this, because it doesn't make sense for them to do it just because of cost, right? So that's what Teradyne does. So let's take a look at their growth, right? What's their earnings growth as well as ROIC. So let's dive into ZRS here, and we can take a look at this here. I built a custom chart, and I can walk you through doing this on your side. If you do want to recreate this type of a layout, I'd be more than happy to do that. But basically, in a nutshell, I went over here to custom and create new custom view. And you can walk through the step-by-step process to do that. I just have this type of split screen here, where one chart on the left side and two charts on the right side, and you can sort of design your own view. So I added revenue on the left side, earnings on the top right corner, and then free cash flow on the bottom right corner. You can see that revenue growth has been phenomenal over the past 10 years. The growth rate of revenue has been roughly 8%. So not extremely high, but you can see that it's tracking above trend right now, especially in 2020 and 2021. So I expect that long run 10-year revenue growth rate to accelerate as the world moves more and more into reliance on semiconductors to power AI and machine learning, as well as to power the rollout of 5G. So that's really accelerated the revenue growth here in the more recent past. And you can see as well what's their earnings growth looking at, like that's around 14% over the past 10 years. You can see that slope that shows up as I hover over that trend line. And then of course we always like to look at free cash flow because I always like to say earnings growth is meaningless if it's not accompanied by free cash flow growth, or at least net cash from operations. We want to see confirmation from cash flow. Otherwise, earnings growth is meaningless because that could just mean that the company has, significant accounting issues, or they have a lot of their, earnings are simply accruals rather than true cash collection. So I love to emphasize cash flow to accompany earnings growth over time. So earnings growth is great at 14%. You can see that as well. That's actually accelerated along with revenue growth. So we are tracking above trend really for the first time in the last 10 years. The last time this happened was in 2012. So this is very, very bullish for Teradyne. Let's look at their ROIC, because remember, earnings growth is great, but what if it requires a lot of investment to achieve that earnings growth, right? So we want to know what is the rate of return on their investments. And Teradyne is a heavy industrial manufacturing company. So, CapEx is probably a big part of their, overall spending. So for a company like Teradyne, the return on invested capital is especially important to look at. So let's dive into Excel world here. And this is a template that I have built that looks at ROIC. I just built it in this way because it's slightly different from how the system does it. The system does it also in a perfectly good way. I just like to look at it from, in this sort of layout. It just makes it super easy to look at revenue and cash flow growth, as well as ROIC down at the bottom. So I'm just going to enter in Teradyne, and I'm going to come into the Zacks plugin in Excel here and hit refresh all. And what that will do is it'll read the ticker that I just entered in that top left corner, and that will then grab the latest data and show you, what that revenue growth and net cash from operations growth looks like. So we can see the revenue growth again. This is the same thing that we saw in the previous chart, just in bar chart form. Net cash from operations growth, all looking great. But here is the kicker, right? This is the big thing that I love to look for. I love to see this right here, which is a positive rate of change in the ROIC. And we are now looking at 30+% ROIC, which is excellent. Not many companies have this. There are many growth companies out there. We have similar companies that have 15% growth in line with what Teradyne does, even 20% growth, 25% growth, but they don't do ROIC at 30%. What does this mean? If you have two companies, right, all things held steady, both have 15% earnings growth, but if one has 30% ROIC and the other has 20% ROIC, the company with 30% ROIC will necessarily outperform, all things held equal, right? Everything else held equal. They both trade at the same valuation. They both have a similar cost of capital. So all things held equal, two companies that have the same earnings growth rate, the one that has the better ROIC will outperform the one with the inferior ROIC. Why is that? Because that is the capital efficiency. This company is earning a 30% return for every dollar of capital that they deploy. So for all of their CapEx that they invest in their machinery, in their factories, in all of the spending that goes on in that, for every dollar that they invest, they're generating a 30% return on that investment. So that is a very attractive return for shareholders, because where else can you get that, right? If you as a shareholder have $1 of investment capital, where would you find a 30% return on that capital? It's hard to find that. There are a few companies like that, and that's what my goal here is, to uncover those types of companies. And Teradyne is one of them. So internally, their rate of return is phenomenal. Not only is it a very high ROIC, but it's a good rate of change as well. So they have gotten increasingly efficient at generating, profit per dollar of capital that they deploy. And over here, I also have cash flow return on invested capital. So that looks at the same exact denominator, but the numerator is net cash from operations. And again, I always like to see that here because we want to always make sure that net income is accompanied by cash flow. Because if it's not, then there is, a red flag that you need to look into further in terms of their accounting. I always like to side with the cash flow. You can see, for example, I'm just going to pivot really quick here to Amazon, because Amazon is a great example of a company that, didn't necessarily have a very good ROIC, but had a phenomenal cash flow ROIC. So that's also something to pay attention to as well. I always side with whatever cash flow from, cash flow ROIC does. So if a company does not have necessarily a good ROIC, but has a great CF ROIC, I would go with that. And you can see here, Amazon did very poorly. In fact, they had a negative ROIC. In fact, it was actually negative for a brief period of time. It was going down very small, low single digits, negative at one point. Even when it rebounded, it was still not doing a great ROIC at 6%. That's not great for tech. You can see this phenomenal growth, but very poor ROIC. That tells you very poor capital efficiency. However, if you look over here to cash flow ROIC, that was north of 30% the entire time. So that is very, very critical to see that and make that distinction. This is a company that, invested so heavily, so aggressively back into their business that it artificially depressed their net income in the form of high depreciation expense, as well as high stock-based compensation expense. However, those two factors do not affect net cash from operations. And so that's why if you add those back, you can see that the actual return on, every dollar of investment capital was producing returns north of 30% that entire decade. So again, this is very, very critical to make that distinction. And I love to see that here. So as long as a company does, strong cash flow ROIC, that's what we want to see. And then, lastly is, fair price, right? We want to know, do they trade at a fair price? So let's go back into ZRS world. And if we go into the valuation model, this will tell us exactly what the company is worth, right, relative to their earnings growth potential. So if I go over here to default model, we're going to just start from scratch here. What this valuation model does is looks at the long run analyst growth rate estimate, and that's coming in about 13%. That's roughly in line with what we saw in the previous slides in terms of their long run earnings growth, coming in at about 14%. So if we model just what they have always done in the past, right, 13% to 14% growth, look at that upside potential here, 93% upside. What this means is either the market thinks that this discount rate is a little too low, or the market thinks that their growth rate won't be as stellar as it has been in the past. However, what this tells us is that because this is such a high model return, we have a lot of room for error, right? And that's what we call the margin of safety. Warren Buffett has talked about, Charlie Munger has talked about this all the time. Seth Klarman, other great investors have always talked about margin of safety, which is that we want to be buying companies that, based on our assumptions of growth and discount rate, trade at a substantial discount to intrinsic value, or at the very least, trade at a fair price. Because what that does is that it gives us a lot of room for error. So we could be wrong on earnings growth expectations, or we could be wrong about interest rates. If the 10-year treasury yield dramatically rises to say 2 to 3%, we could still be wrong about that rate of interest, or the macro risk appetite and still do well with these companies because they trade at such, substantial discounts to intrinsic value, or have, the ROIC to be able to compound capital and grow through any kind of macroeconomic headwind coming from the, interest rates or coming from the Fed. So this is that, 5-step, approach we just took for Teradyne. And, we can run through the others, as quickly as possible here, just out of the interest of time. The next one is CBRE. So what is CBRE? They are the world's largest commercial real estate services and property development firm. They are the #1 global market position, so they have dominant market share, right? So that alone tells you, a little bit about the moat, right? Which is their network effects, right? They have significant experience, they have deep industry expertise, and they have a dominant market position in an industry that is continuously expected to grow, over time. Because real estate is one of those, rare industries where, you really can't, expand the amount of land that exists on Earth. Obviously, we can continue to expand, property construction, but land is a fixed asset. It can't really grow over time. And they have a massive TAM because of an increasing need for integrated property management. There's a $1 trillion real estate market that's, projected to grow steadily over time. So CBRE, what have they really done to cement that status? We can kind of look at their, just a quick look at their webpage, right? The world's largest commercial real estate and services investment firm, 2020 revenues of 23.8 billion. So again, phenomenal company, a lot of, industry expertise. What does their growth rate look like? So let's go back to growth here. What have they done historically on both revenue and I always like to look at both revenue and earnings as well as free cash flow, because look, revenue earnings growth sometimes is misleading, because if a company has a significant buyback going on, then their earnings growth could be, artificially inflated, because, obviously if that denominator is shrinking, then the earnings per share could be much higher. So what is the actual long run sustainable growth, right, for a company? And ultimately, a company cannot grow faster than what the top line is growing, right? After a company exhausts its operating leverage, or after it, a company, buys back as much stock as it possibly can, at the end of the day, earnings growth can only be as fast as revenue growth. And so revenue growth has been phenomenal, over the past 10 years at 20%, least squares growth rate. So that's, again, phenomenal. What's their free cash flow doing, right? And that's been at 28%. So right off the bat, the earnings growth of 15% has been actually one-upped by free cash flow at 28%. Awesome things to see. That's all great things to look at. So what's been their return on invested capital? Keep in mind, CBRE, again, is a real estate firm, so it's similar to Teradyne, which has substantial investments in factories and CapEx, right? In the same way, because CBRE is a property developer, they also have significant costs, right, that goes into property development. So on one side, they provide real estate property management services. That's a service. Services have higher, margins, but they also are a commercial real estate developer. So those have slightly lower margins, right? So we want to know, what is that return on invested capital, right? What is the return per dollar of total assets that are deployed, right? Total capital that's deployed. And you can see here, very, very good. Obviously, it's not Teradyne level of 30% plus, but it's still a pretty good, level of 13%. Now, CBRE did get hit by the COVID disruptions. You can see a little bit of a pullback here, but I believe that if we do reemerge out of COVID, as long as we don't get, further, lockdowns or, if we have other, disruptions to, global real estate, I think that, CBRE is poised to retake that high here, which is at around 15 to 16% ROIC, which is also, again, very good to see. We want to see that, in the 15% range. I think that's usually a good number to look for. I know Charlie Munger likes to look at that 15% mark a lot. Nothing magical about it. 15% doesn't mean that 13% is bad. But again, it's a company that has, solid growth as well as a very respectable ROIC at currently about, 13%. But I think if we do recover out of, this, pandemic, which I think it will be the case over the next year or so, I think this will, take out, this previous high. Also, what to, keep in mind of as well is this rate of change, right? We love to see that. I love to see that, grow over time. So this tells you that not only is the company doing, a pretty good return per dollar of invested capital, but that they're getting increasingly efficient at it and getting more and more per dollar of capital that they deploy. So, and that's confirmed by their cash flow return on invested capital as well. That one is at 18%, so that's even better than the 13% that they're currently doing over on the traditional ROIC side. So all great stuff. We have great growth. We have dominant market position. We have network effects that gives them a moat that's very, very tough to beat. They are involved in some of the largest real estate projects around the world. So those relationships that they have built with clients have been etched in stone, in my view. So it's really, really tough to disrupt a company like this. Now let's look at their valuation. So is it trading at an attractive valuation? So let's take a look at that. CBRE, again, if I were to start from the default here, 11% growth is what the sell side is expecting, long run. So if we model that 11%, look at that here. Again, it trades at a 58% discount to intrinsic value. Now, this is a little bit of a high beta company, right? It's at about 1.5 beta. So we can always, introduce a company-specific risk here. So if we wanted to add, say, a 1.5%, additional company-specific risk, we can do that. And even if we did that, you can still see that the company's shares are still trading at an attractive discount to intrinsic value. So this tells us that, let's say that, let's say that the 10-year can, surge to say 2%. If we look at that here, 2.36, let's just say, it still trades at a pretty big discount to intrinsic value. So adjusting for the high beta nature of this company and assuming that, say, for example, the 10-year treasury yield surges to 2.3%, 2.4% even, you can still see that the company trades at a discount. So this is exactly what we want to see is companies that relative to their growth rate, discounted back to present terms using this total discount rate that we have here, assuming a substantially higher 10-year treasury yield and, factoring in their high beta, nature, this is still a company that trades at a very reasonable multiple, a very reasonable valuation. Also notice that I don't use PE multiples at all, through this entire analysis. PE multiples are helpful just as a quick look at a company's where it trades at relative to its earnings or relative to its cash flow. But the best way, in my view, to value companies is to project its earnings growth over time, discount that back to present terms, and look at that number, that intrinsic value estimate, relative to where the market prices the equity right now. If there is a significant difference between that, that's where there is an opportunity. And then if there's still a discount, even after we factor in substantially higher interest rates, again, that gives you confidence that there is a margin of safety embedded in CBRE's equity valuation right now. So again, dominant market leader, very, very strong network effect moat, excellent earnings growth, very, very good return on invested capital. And it trades at a pretty good discount to intrinsic value. So we have that margin of safety there as well. By the way, I should also mention that ROIC, another reason why it's so important is because that actually quantifies the presence of a moat. So not only does it tell you how well is management deploying capital, right? It's a direct reflection of management's capital allocation strategy, but also it is a possible indication of a moat, of the presence of a moat. So if a company consistently does high ROIC for a long period of time, let's say 3 to 5 years, what that tells you is that, well, not only are they generating very high returns on capital, but it's also not eroding from competition or from others that are entering this market or from others that are potentially doing a similar thing, right? So that's also a key thing to note, because if a company does very strong ROIC, what that does is that it's going to attract attention, right? It will attract attention from competitors seeking to get a piece of that action. And if that ROIC does not erode over, say, a 3 to 5 year time frame, what that means is, even if there are competitors entering the market, the investors or clients or customers are not moving away from this company in significant numbers or even in relevant numbers at all. So that tells you that there's something that this company is doing that customers are continuously coming back for, right? So that's another major reason for why ROIC is very, very important to see. Even more important than margins, I believe, is the ROIC. So that's CBRE. And then the last company that I wanted to showcase here is Ubiquity. So what's Ubiquity? Ubiquity is a integrated IT network hardware and software firm. And what they've done is created a entire line of products, network IT products. So they make, they make wireless networks, they make, cameras, they make all sorts of, wireless network IT administrative, equipment, as well as accompanying software. So what's really interesting about them is that they have figured out a way to streamline all of these different IT hardware and software infrastructure in a way for someone to be able to manage it centrally on a single app or a single website that they can look at. So to make this a little bit easier to understand, let's just pull up their website again. This is something that I love to do. Just look at their website and see exactly what they do. So you can see that they make these types of routers, right? As well as accompanying pieces of equipment such as wireless access points. They also make cameras. They also make other things that allows IT administrative companies or IT admin departments of companies to be able to centrally manage everything in one spot. And what's also really cool is this is something that appeals to not just IT departments at firms. So it's not just a B2B company, but it's also a B2C company. So they sell these devices also for use for individual retail. And if you actually go to YouTube, for example, and just type in Ubiquity and just see what comes up, interestingly, there is almost a cult-like following of individuals that are really, really into this platform that they have built. So it's something that has caught on very, very rapidly in terms of market share. So if we look at what their growth rate has been, it kind of gives you a quick, very almost immediate answer as to exactly what they've been able to do. So if I type in UI in here, we can see that their growth rate, right, has basically been, exponential. If you look at that here, it's been just a phenomenal growth story. 20% growth over the past decade, again, and tracking above trend in the past year and a half or so. And that's projected to continue for some time as well. So on a earnings growth rate, 27% growth, again, absolutely phenomenal. And, free cash flow growth as well, coming in at about 26.5%. So again, very, very strong revenue growth, earnings growth, free cash flow growth. Checks off all the boxes. We want to see that, happen more and more. Here's the kicker. If I come back into ROIC world here, this is, something that I almost, fell off my chair about, because if you look at their ROIC, that is something out of this world. Now, do I expect it to be as, great as it is right now? Probably not. However, it's got, a long way to fall and still be significantly better than just about any IT administrative, firm that I've seen. The ROIC here is just absolutely ridiculous at 100%, both on, ROIC as well as on cash flow ROIC. So this is amazing, right? And the reason for that is because they're very asset light. So they not only produce, hardware, but the key reason for why this is such an incredible ROIC company is because the majority of their revenue is high margin software as a service. And that's where they really earn their income from. And you can see here that their invested capital is actually very, very light. So they're very, very asset light. This is another very, very important thing to look at as well. Companies that are very asset light, they generate high margin revenue. So, in this case, these revenues here will get a very high multiple because of how high of a gross margin that they generate. So you can actually see here, if I were to switch over to gross margins, you can see exactly what UI does. Their gross margins are at 50%, so very strong there. We can actually see their net margins as well as very, extremely high as well. So again, these are examples of companies that are asset light. They're software, driven. That's why their ROIC is very strong. But then let's look at, some of their, what their valuation looks like. So for a company that grows revenue at 20%, earnings at 27, 28%, this is a very, very, this is a very tame multiple. They trade at 28 times earnings. Even if you were to adjust for, their high beta nature, it's at about 1.35 beta. So if I were to just type in, 1.35% as our, company specific risk, again, even assuming, the 10-year treasury, surges by, 100 basis points here, I think that Ubiquity trades at a pretty substantial discount, to intrinsic value. For a company that grows grows earnings at such a rapid rate, this is a very, very tame, multiple here that you can see. So I think this is something that is, that checks off all of these points that we talked about, right? We talked about, earnings growth, very strong returns on invested capital, very large total addressable market. Actually, let's look at that. If we come back here to Ubiquity, again, they create this integrated IT network, hardware and software that allows you to streamline everything into a single app. It's a massive total addressable market. This is actually a small upstart relative to the big players out there, like Cisco, for example. So if you look at their total addressable market, they have a lot of market share that they can grab from the embedded industry players like Cisco and others. So the global internet traffic is expected to grow from, this is something that they disclose as well on their annual report, from 122 exabytes, right, per month to 396 exabytes by 2023. That's a 28% CAGR, going out into the foreseeable future. And they are projecting that individuals at a household level are expected to grow from having 2.4 networked devices on a wireless platform, on a wireless network at home, to about 3.6 devices. So that's telling us that, individuals at the household level are putting more and more devices onto their home wireless network. And as that happens, right, as the number of devices grow, as more and more people have smart homes, for example, they have cameras that are connected to wireless equipment. They have, other, for example, wireless entry, for their locks on their doors. As more and more things in the home become attached to a central wireless network, Ubiquity becomes more and more useful for people because it provides a centralized place to be able to control everything from one single app. And that's what they have built here. So this is expected to grow. I think this growth rate is sustainable because of that fact. As individuals have more and more, devices that they add to their network, and simply as global network traffic grows over time. So this is a moat, I think, in the form of brand loyalty in a way, as well as functionality as well. So again, this is a growth rate that I think is sustainable going forward. So again, I hope this was helpful. There are, many more companies that we can, talk about here. There's others here as well. Tons of companies that, match this general framework of earnings growth, ROIC, large total addressable market, looking for a moat, and trade at a fair valuation. But if you have these 5 steps in place and have at least some evidence, some measurable evidence of each of these 5 things, I think as a long-term investor, you will do very, very good. You will most likely beat the market, in my view, over a long run cycle, especially if you have an adherence to buying significant drawdowns as well. Obviously we can find and estimate what the fair valuation of a company is, but sometimes the market gives us substantial opportunities as well, such as major market crashes and things like that. So if you have all of these checked off, right, all 5 of these checked off, and then suddenly the market tanks, we get a bear market and everything is down tremendously. If you have that conviction in these long run sustainable trends that the company is on a path for, and if you buy that major dip, I think that will actually enhance your return even more over the long run. So I hope this was helpful. If you have any questions, I'd love to take them now. You can enter them into the GoToWebinar panel here. Or if you have any other questions that you can think of, feel free to email them to zrs@zacks.com. I'd be happy to, respond to you. As well as if you wanted to set up any of these charts that we walked through, or this spreadsheet that I have here, the CFR, this ROIC spreadsheet, I'd be happy to also provide that to you as well. Or if you have any companies that you wanted to walk through, for example, using this framework, again, I'd be happy to walk you through that as well. So with that, we will, end our presentation today. And I would, again, hopefully you found this helpful, and we will see you on the next webinar as well. All right, thanks everyone. Have a good one.